This is Scott Becker with the Becker Private Equity and Business Podcast. We come to you daily with short business episodes, short private equity episodes. We try and make sure that you're learning something, that we're learning something, that you're also entertained some. We've got today two brilliant leaders from JP Morgan Chase. I can't tell you how thrilled we are to be visiting today with Danny Resnick and Michael Smith, two different areas of JP Morgan Chase. Danny, Michael will talk about trends you're watching, what you're most focused on, advice for leaders, and a lot more. Can I ask the two of you to take a moment and introduce yourself? Michael, why don't you kick us off, and then we'll go to Danny to do the same.
Yeah, happy to. And Scott, thanks for having us on today. My name is Mike Smith. I'm an executive director in JP Morgan's mid-cap investment banking group, and I'm focused on healthcare clients. So my group helps businesses with capital advisory and capital raising solutions. So I work with a lot of founder-owned healthcare services companies, healthcare providers, private equity-backed businesses, and publicly traded companies. And we help them raise capital in the public and or private debt and or equity markets and help them with strategic growth to enhance their long-term value and the value for their shareholders and stakeholders. I personally spend about 80% of my time focused on M&A advisory and private capital raises. And I've been with the firm for about 3 years, came over from another investment bank focused on mid-cap clients. And again, appreciate you having us on today, Scott.
And Mike, take a moment and tell us, what does the environment look like today for M&A in healthcare? I know we're seeing rapid pickups at some of the consulting services firms and more private equity back at it some. What's your sense of what you're seeing in terms of market activity? Can you give us a quick sense of the feel for what's out there?
Yeah, you hit on some of our leading indicators that we like to look for are quality of earnings providers, consulting firms, a lot of the advisors outside of the formal M&A advisors that are in and around processes and their capacity. And all signs are pointing to 2021 was a sort of an anomalous year. It was the record of all record years. And what we started to see leading up to that 2021 period was you would call a quality of earnings provider and they would say, sorry, there's nothing we can do. We're 6 weeks backlogged. We're not nearly at that phase yet. However, every conversation we have, again, with the third-party consulting firms, quality of earnings providers, are, well, we're starting to get busy. So if you guys are actually planning to go to market, let's lock this in now. Whereas a year ago, those conversations were more akin to, yeah, we've got capacity. Don't worry about it. Let us know when it's time to go. So our biggest leading indicator, obviously internally, are signed mandates. And we feel very good about where we're at from that perspective, particularly the group that I sit within. But it's similar chatter that we're hearing out in the market. And those leading indicators all point to a constructive deal environment in 2025.
And I had the chance to visit with you not that long ago, a few months back. And really what's amazing about JP Morgan Chase is you folks have stayed fairly busy through what for many people was a challenging period of time in terms of the deal world, deal environment. Are there specific areas that you're most focused on and most interested in, Michael? And then we'll turn to Danny in a moment. Are there specific areas that have helped keep you folks busy and any thoughts there?
Yeah, so I would say for us in particular, what's kept us most busy is I think we've got a pretty unique, and this is not intended to be a commercial, but a pretty unique ability to serve clients up and down the size spectrum and regardless of the client dynamics. So you've had a lot of private equity funds that have very strong assets that in other markets may have been in the market already, but they've hesitated because of what they either paid for the business a couple of years ago, where they're at in their hold period, or just general sentiments around the market, which is the complete right thing to do. So a lot of private equity sellers over the course of the last 12, 18, 24 months have shelved assets or held them a little bit longer, even moved them into continuation vehicles or continuation funds. Where we've been able to differentiate is we have great connectivity, and this is where Danny and I partner particularly well with founder-owned businesses, where the dynamics are different. It could be a founder that's looking to transition because, I'll go to my physician example, they're looking to retire. Or it could be a founder who's looking to diversify their estate for estate planning purposes. these founders, I would say, have been a lot less sensitive to and dependent on market conditions. So we've been able to continue to show our private equity clients good deal flow, good content, and set up meaningful dialogue, despite it being somewhat of a down market, just because we have access to and connectivity with sellers that are thinking about the world differently.
Thank you. And what a fascinating perspective. I've watched upfront and personal how well you guys have managed and navigated that, exactly what you're talking about. Danny, let me turn to you for a moment. I've known you for a long time, one of the highest integrity leaders I know. You've now been at JP Morgan Chase for a long time. I remember you coming over there, I don't know how many years ago it was now. Tell us about yourself some and about the practice you've built and the group you work with.
Absolutely. Thank you, Scott. This is a real treat for me. So, and as you are an attorney, I know, Scott, by training, you will appreciate that we may touch on some topics today related to tax and estate planning. JP Morgan Chase does not give tax or legal advice. Only your listeners' attorneys and tax advisors can help them consider whether the strategies we discuss today are appropriate for their individual circumstances. So, Scott, I have been at the firm for 16 years, all with JP Morgan Wealth Management. I lead the Resnick Group. We're a 4-person wealth management team in Chicago, and many of my team's clients are business owners in the healthcare space. I am designated as a wealth partner, which is a segment of our advisor population focused specifically on ultra high net worth clients. Scott, we serve our clients in 4 areas. 1, wealth planning and advice. 2, investing. 3, banking and lending, and 4 is corporate retirement plan consulting.
And let me ask you the question, because everybody always wants to know this. When you talk about ultra high net worth individuals or families, where does that quantify as? Where does that start to look like? And what does it look like who you work with?
Yeah, absolutely. And different firms, different advisors have certainly different definitions there. For our business, when we reference ultra high net worth, we are referring to clients with an investable net worth of $10 million or more.
Thank you. And talk about, you're both a leader at a bank, great organizational and people skills, also extremely bright. I know a Northwestern grad from some time back now. What advice would you give to people getting out of their MBA, getting out of school? Any thoughts you'd have there along those lines, Danny?
Yeah, well, I think for me in particular, is you referenced the MBA. I do have my MBA. I did my undergrad at Northwestern. I also did do my MBA at Northwestern. I think for me, the advice I would give to MBA students who are trying to maybe figure out what they want to be when they grow up is to really think long term about where they want to be and what they're most passionate about. I think, especially in an MBA environment, there tends to be a decent amount of groupthink, and a lot of the MBA students wind up kind of siloing themselves into careers where there's an active recruiting process on campus. The salaries may be a little higher up, right out the gate, and of course that's appealing. But I think, for those that may have a more of an entrepreneurial itch to scratch, I would encourage those students to think a little more outside the box than some of the traditional MBA career paths.
And you've lived one of the pieces of advice that we think about often is that if you get your place into the right culture, you'll tend to thrive, particularly if by nature you're a motivated, smart, personable person. You, I know, transitioned yourself 16 years ago into the perfect culture that fit you well, and you've really excelled and thrived. But let me turn it back to Michael for a second, and I'm going to ask you a very tough question in a little bit. Michael, let me ask you this. What do you see in the deal environment for 2025, trends you're watching, and what are you most excited about?
Yeah, again, going back to one of the conversations we had a couple months ago, Scott, taking a look at the M&A space over the last couple of years, 2021 again was a record year. That momentum carried over into the early part of 22, and then really stopped on a dime. So activity started to come back in 24, especially when we compare it to 23, which was a down year, even when not comparing it to record years. But what we as bankers have been waiting for is the dam to really break since that mid-2022 timeframe. And there are certainly headwinds, geopolitical, rate uncertainty, broader macro and consumer question marks still out there. But there's also tailwinds that I'm very excited about. As we think about 2025 trends that we're watching, it feels like we've got the right catalyst to start to mitigate that. So election uncertainty will certainly be behind us. And I think regardless of who ends up in the White House, not having the election lingering is going to be a good thing regardless of who ends up winning. Private equity dry powder still remains high. We've got an IPO market and subsequent trading levels of those inaugural offers, particularly healthcare services businesses, that's been very encouraging. To me, and again, I go back to a conversation we had a couple of months ago, Scott, the biggest constraint has been a bid-ask spread, or the difference between what buyers are willing to pay for businesses or have the ability to pay based on market conditions, and what sellers' expectations are around value and deal terms. Anecdotal, but also data pointing to show buyers are very eager to write checks. And while it feels like they're still taking a more conservative view on taking risk, particularly compared to 2021, buyers are trying very hard right now to get deals done. The seller side of the equation is moving more towards that equilibrium as well. Again, whether it's founders, sponsor-backed businesses, or carve-outs from the larger publicly traded companies. Obviously, sellers are still focused on value maximization, as they should be, but there's been certainly a realization that some of the things that buyers were paying for in 2021 are not going to be the norm, and that's not what things are going to look like going forward. So if I go to a healthcare business, one that's growing and opening new locations, an active de novo strategy, in 2021, you were able to get credit for those, essentially for thinking about a new de novo and identifying a new site. Now you need to have that site open, seeing patients, generating revenue, and even approaching profitability. So I think that sellers, again, have become accustomed to the market moving back towards what it had been historically and not looking towards that record year. So to me, it's all about that equilibrium. And as I think about 2025, again, all of the pieces are there for that dam to break. And it feels like it's going to be a constructive and exciting year. From our perspective, I think it's just about continuing to be in front of clients, whether those are buyers or sellers, investors or operators, and having those meaningful dialogues on how to drive that strategic long-term growth so that we are in the right spot to bring the right opportunities to buyers and to bring the right buyers to our seller clients. And again, just having those conversations, being active in those dialogues is our best way to do that.
Fantastic. And Danny, when people are thinking about wealth planning and wealth management, and if you're a founder selling a business, once you sell a business, do you put all your money in one stock? How do you look at some of those things? And I know you can't offer investment advice here, but how do you start to manage either prior to a sale, how a founder thinks about he or she or company leadership thinks about portfolio management? How do you start to think about those things and think about estate planning? And just give us a few thoughts there as to how do you start to work with people on these types of concepts?
Yeah, absolutely, Scott. This is a topic that I find very intellectually interesting. So I'm glad you asked. I think take a little step back here as we're approaching obviously a pretty watershed moment here with the election next week. I think we can all agree that there is a forecast for larger and larger federal government budget deficits. And I think as such, it seems fairly plausible that tax rates could go up in the future. So there are really two wealth planning strategies that we are focused on to help clients navigate potentially higher tax rates. And this jives exactly, Scott, with sort of your question, especially for business owners who may want to be preparing for a sale. So one of these strategies addresses the estate tax. The other is related to capital gains taxes. So the first strategy is related to the 2017 tax law that doubled the lifetime gift and estate tax exemption. And you and some of your listeners here may know that that exemption currently is $13.6 million per person, which is about $27 million for a married couple. That increased exemption amount is scheduled to sunset, which means it will be cut in half at the end of 2025. Tax policy is obviously notoriously difficult to forecast, but we are recommending that clients work with their attorneys to consider if it makes sense to transfer assets outside of their taxable estate before the end of 2025. And for owners of privately held businesses, under certain circumstances, their company stock can be an advantageous asset to use for estate planning purposes. So that's sort of the first strategy. The second strategy is more related to income or capital gains taxes for clients who are contemplating a transaction, especially as Mike mentioned, that we are seeing some green shoots for potential for elevated deal activity here in the coming year. For clients who sell to a private equity buyer, they're often receiving a combination of cash and rollover equity in the new company as part of the deal considerations. It will often make sense for clients in this situation to invest a portion of the cash they receive into public equity markets. And to achieve this equity market exposure, our team typically uses a strategy called direct indexing, which has two objectives. One, minimize tracking error to a passive index like the S&P 500. So Scott, as you sort of referenced, we are not likely to advise our clients to concentrate their wealth into one security or a small group of securities. We believe in diversification, and a big broad passive index like the S&P 500 to us makes a lot of sense for our clients who are going to allocate money to public equities. The second part of this strategy is, when available, the strategy will look to harvest capital losses. And so after several years, the potential result of this strategy is that portfolio returns have closely tracked an index, the S&P 500, and our clients have often built up a capital loss carry forward from the loss harvesting activity in the strategy. Now back to this rollover equity piece, Scott. When that rollover equity is eventually sold, which is typically, we'll call it 5 to 7 years after the initial transaction, it can result in a large realized capital gain for the business owner, who oftentimes has very little basis, right, in the original business. Depending on that investor's specific tax situation, the capital loss carry forward can be used to help shield some of the capital gain on the sale of the rollover equity. So long-winded answer to your question, Scott, but we do believe there is a meaningful chance that tax rates are going to go up in the future. So these are the types of strategies that we are discussing really closely with our clients and their tax and legal advisors.
Thank you. It sounds like if you haven't used up your estate planning exemption before the end of next year, you should use it. That's why you should talk to your attorneys and advisors. You don't want to lose the opportunity to use that, particularly if you've got enough net worth outside of that. So that, I think, is point one that you made. I think that's very, very important. Then there's different ways to work with this as well. If you own a privately held company, there's ways to potentially get family members who you want to leave money to shares of that company that at one value, and they might at some point end up selling at a very different value. So it's also a way to arbitrage some of that estate planning number. And I don't want to overstate that, but that's the opportunity, is taking a company that's got privately held discounts, and then when it's sold, maybe having a delta or an increase. So you've taken better advantage of your estate planning exemptions. And so many are the thoughts out there. I'll ask you a difficult question, Danny. If you were a college basketball coach, is it similar to running a team at a wealth management group, or is driving a team and leading a team at JP Morgan much harder than the sort of play job of being a college basketball coach? Is that an easy job comparatively?
Sure. Listen, we could go on and on about the ever evolving and I guess rapidly changing landscape of college athletics, Scott. That I wouldn't wish that job on a close family member of mine, right? there's a lot of considerations now with the ever evolving NIL landscape, the transfer portal, et cetera. It's an exciting time. But that is managing that type of team. You've got a lot of stakeholders there, Scott, probably even more than I have on my own team.
Yes, and for those that are not aware, Danny has a family member who's a Division I basketball coach. Thus, the question and the implied humor in the question. But that being a leader in college athletics has become incredibly challenging. Michael, I'm going to ask you a similar question. Is this the year that Indiana University runs the table, or are there roadblocks in front of the IU football team, which is now 8-0?
Man, it's a tough one. I don't think that I can go out in the public domain and have myself heard saying anything other than I think they're going to run the table. They've got Ohio State the week before Ohio State has Michigan, so there's a chance that they're taking their eye off the ball there. I think that's their greatest test, and I think that they're going to emerge victorious. I feel very good.
Now, I don't know the Northwestern fight song, so I won't harm anybody with my singing, but I do know Indiana, we will fight for the cream and crimson and the glory of old IU. Now, the audience should be thankful that I'm not singing, but, we'll cheer for Indiana to continue. At one point, they were a basketball powerhouse. Now they've been relegated to football powerhouse, but great fun to watch. Mike and Danny, I want to thank you so much for joining us today on the Becker Private Equity and Business Podcast. I'm so impressed by the leadership of JP Morgan, both you folks particularly, and then Jamie Dimon and the entire firm. Amazing leadership and just the most principled of the principled. Thank you so much for joining us on the Becker Private Equity and Business Podcast.
Thanks for having us, Scott.
Thank you so much, Scott. Really appreciate the opportunity. It's great to visit with you.